In the booming economy of the late 1990s, an American energy enterprise operating out of Houston, Texas, became the undisputed king of the corporate world. Enron rapidly expanded from a regional gas pipeline operator into a multi-billion-dollar global financial empire. Wall Street analysts treated the company with absolute reverence. Driven by their praise, Enron's stock price soared to an all-time high of $90. The optimism was contagious internally. Enron's own employees trusted the financial reports completely, routinely investing their entire life savings into company stock. By earning the title of America's most innovative company for 6 consecutive years, Enron cultivated a public perception so overwhelmingly positive that no one dared to question the underlying math. Control of this narrative and sprawling operations came from the very top of the corporate hierarchy. Kenneth Lay served as the visionary executive and the trusted public face of the enterprise. Beside him was Jeffrey Skilling, the aggressive operational architect Wall Street hailed as a financial genius. But behind those glass towers, America's most celebrated company was secretly bleeding billions of dollars. The executives hadn't discovered a flawless business formula. They had engineered a method to mathematically camouflage a fatal financial hemorrhage. Traditional accounting practices could not hide Enron's massive operational losses. To survive, the executives deployed a highly aggressive accounting loophole. This timeline illustrates their weapon, mark-to-market accounting. When Enron signed a deal, they projected hypothetical future revenue, legally logging it as actual present-day profit immediately. When projects failed and generated no real cash, Enron ignored the physical losses. The phantom profits remained fully intact. Enron had legalized the printing of fake money, creating a sprawling paper empire that was entirely detached from physical cash flow. While the phantom profits looked great on a ledger, the real-world projects were still failing. This created massive, undeniable physical debts that had to be hidden from external auditors. The task of burying this toxic debt fell to Chief Financial Officer Andrew Fastow. Fastow's ultimate solution was to quietly construct a vast, deeply hidden network of entirely off-the-books shadow companies. This diagram shows how the mechanism worked. Enron secretly funneled its massive, crippling liabilities off the primary ledger entirely, moving the real debt into these concealed shell corporations so it would never trigger an alarm for investors. On paper, Enron appeared to be an unstoppable money-making machine. In reality, the internal foundation of the corporation was rotting away. The entire heist depended on a fragile, perfect equilibrium, an engine constantly manufacturing fake cash, perfectly balanced by a vault burying the real losses. That fragile equilibrium broke in mid-2001. Whistleblowers and financial journalists began digging into the statements, asking exactly where Enron's cash was actually coming from. As the mathematical contradictions became impossible to ignore, rumors spread, and sheer panic took hold of the investors. This chart tracks the resulting panic. Enron's stock violently crashed from its high of $90 a share to less than $1 in just a few months. In December 2001, the company filed for Chapter 11 bankruptcy, marking the largest corporate collapse in American history at the time. Over 20,000 employees instantly lost their jobs, while the executives who orchestrated the system had already secured millions in personal wealth. Because the workers were heavily encouraged to invest their retirement funds into Enron stock, their life savings vanished completely into thin air. The legal fallout quickly expanded to the institutional enablers who certified the illusion, specifically Enron's prestigious accounting firm, Arthur Andersen. Federal investigators discovered that the firm was actively shredding thousands of incriminating corporate documents to cover up the extent of the fraud. The firm was found guilty, and Arthur Andersen was completely dissolved, erasing a titan of the global financial system. Kenneth Lay and Jeffrey Skilling were both convicted of massive fraud and conspiracy. Jeffrey Skilling was sentenced to 24 years in federal prison. The Enron scandal remains a permanent cautionary tale. It proves that a group of the self-proclaimed smartest guys in the room still cannot outrun the brutal mathematical reality of their own greed.